All right, everyone. Thanks for joining us this morning. We're going to take a look back at 2020 from a capital markets perspective and try to make sense of what happened. But more importantly, what we can learn from it and how we can apply these lessons moving forward. My name is Michael Canzone. I'm a certified financial planner here at Canter Wealth. Joining me is also Joe Kalmanovitz. He is our head of financial planning and portfolio manager. He wears a lot of hats around our firm. He's a treasure trove of information. And Joe, I don't think I've ever said this. It's actually a pleasure to work with you. So thanks for being.
Thank you. I appreciate that.
Yeah, thanks for being with us. So a couple of housekeeping items. We're going to try to get through the material and time permitting, take a few questions at the end. You can submit a question by using that chat feature that should be in your toolbar. But if we don't have time to get to your questions, you'll be able to submit them in writing, and we'll try to follow up with you a little bit later. So let's kind of jump into the material. Okay, so this is a mountain chart of 2020 of the MSC All Country World Index in 2020. Joe, why don't you tell us what you see? What happened?
Well, as we all know, 2020 was certainly an eventful and unprecedented year in many ways. It was also really a great example of how professional portfolio management can add value. If you recall, at the beginning of the year here, we were just starting to digest the news of a strange kind of new virus emerging from China that hadn't yet spread internationally. The U.S. stock market was actually up about 4 to 5% there early in the year before markets really started to panic, and it became apparent that the coronavirus was spreading beyond China's borders and into the U.S. and many other countries. And when that panic hit, it hit hard. You can see here in February, stock prices really just fell off a cliff. The VIX, which is an indicator of anticipated market volatility, actually hit its second highest level ever as stock prices and oil prices too plunged in both the U.S. and abroad. Markets are very effective at incorporating new information rapidly, and it's reflected immediately in prices. There's obviously no way to predict future price movements, but there were some important things we could do as portfolio managers that can add tremendous value during really volatile times like that. One action we took immediately as prices were dropping was to harvest losses in our clients' taxable portfolios. Many, if not most, asset managers generally wait till the end of the year to harvest losses, if they do it at all. We actually went through about 3 to 4 rounds of tax loss harvesting during this pullback, and we were able to lock in capital losses that hopefully will allow our clients to offset capital gains for the next few years. So those are real real returns that you don't see in a statement showing what your portfolio did, but those are dollars that our clients are saving. When we do harvest losses, just to kind of go over the mechanics of it, we immediately replace the securities that we sell with similar but not identical securities, so that we don't trigger wash sale rules, and that allows us to stay fully invested, so that when the recovery hits, our clients are fully participating. Now, the second really important action that we took was to rebalance all of our portfolios, largely within a week or two of this absolute bottom that we saw on March 23rd. When markets pull back like that, people's natural reaction is to de-risk because the mental pain of loss is so powerful. However, as professional money managers, we view it as an opportunity, allowing us to buy quality assets at a significant discount. It's like having a big sale at your favorite store. It's also why we keep really high quality fixed income securities in our portfolio, which allows us to have an asset class that we can sell from, that's not participating in that downside volatility, in order to buy stocks at a discount. You've all heard the term buy low, sell high. Our systematic rebalancing discipline basically forces us to do that. And being able to buy additional stock at significant discounts not only allowed our clients' portfolios to recover faster, it also provided probably an extra 1 to 3% to our returns in 2020, depending on your asset allocation and the level of stock exposure in your portfolios versus a buy and hold strategy. So, going back to this slide here, we see that markets experienced a rapid recovery after March 23rd. And that's when Congress approved a massive $2 billion rescue package, essentially shooting a bazooka, at the economy with dollars. And investors started to look forward to the second half of 2020 and into 2021. We actually saw a record rise in unemployment during this time, yet the market just kept marching up. It's important to remember that the market is not the economy. It's forward-looking, and all available information is already incorporated into current prices on any given day. So already people were looking at which companies were not just going to survive, but thrive in the stay-at-home sort of lockdown environment. Companies like Zoom and Amazon had huge price gains, but at the same time, whole sectors like travel and hospitality were struggling very badly. So you kind of had this bifurcation in the market as far as the winners and the losers. But you can see overall, prices in aggregate were going up. We see here on June 8th, it was announced that the U.S. was in recession, but it actually started in February. So again, not new news. In March, unemployment was near a record low at 4.4%. The economy was chugging along, but the coronavirus really had a massive impact on that. Retailers, small businesses. By April, it was at 14.7%. That's a huge move in unemployment in a very short period of time. And obviously, we had the PPP loans, we had the stimulus checks, et cetera. That the extension of unemployment benefits. That really kind of put a Band-Aid over some of that, but largely we're still recovering from that. That unemployment number was largely ignored by the market because it had already anticipated that spike and was looking beyond to the next 6 to 12 months. As prices kept marching toward all-time highs, even in the middle of the pandemic and this the second wave that we saw, and really into a very strange election cycle that we saw later in the year. U.S. GDP experienced a record decline of 31.4% in the second quarter of 2020, followed by a huge surge at 33.4% in the third quarter. Tended to calm down in the fourth quarter. We actually just got that number this morning. Fourth quarter GDP was at 4%, so bringing the entire year, basically it was at a negative 3.5%, and yet stocks are trading at near all-time highs by the end of the year. So it's a perfect example of the market and the economy being sort of disconnected. And again, that's because the market's looking forward. What's going to happen next? We already know that this was a tough year. What's 2021 going to bring? What's the new administration going to bring? And we'll discuss that a little later in this presentation. But the fact is, you just can't predict the future. And last year was a perfect example of that. You need to be positioned to capture returns when asset classes surge. The fourth quarter of 2020 was a great example of that. As the asset classes that surged earlier in the year, the big tech type stuff, were replaced by the laggards that struggled earlier in the year, like value stocks, small cap value in particular, which saw a 30% plus gain in less than 2 months at the end of the year. International markets outperforming the U.S., which was a reversal. Our current clients know that our portfolios are tilted towards small cap stocks, value stocks, highly profitable stocks, and we have significant global exposure outside the U.S. So we captured a lot of great premium, toward the end of the year. Mike, if you want to kind of move to the next slide here. Thank you. So this is fourth. These are. Oh, go ahead.
Yeah, here are the world asset classes, right? I want to pause for a second and talk about the MSCI All Country World Index and why we as a firm feel that's an important benchmark for us, for our portfolios.
Yeah, like I said, we view the investment world as our oyster. There's a lot of asset managers that really concentrate on U.S. stocks. That's just a mistake in our view. You look at a decade like 2000 through 2010, which we in the business refer to as the lost decade, essentially saw an inflation-adjusted negative return for an entire 10 years in the U.S. stock market. But if you had a globally diversified portfolio with exposure to all the investable asset classes, international stocks, real estate, bonds, you actually saw a pretty good return during that decade. So I think 2000 to 2010 is a great example of why you don't want to sort of put all your eggs in one basket. Just solely concentrate on U.S. stock exposure, because returns come from everywhere. The United States only represents roughly half of the world's market capitalization. So there's opportunities in many both emerging and developed countries. So anything you'd like to add there, Mike?
Well, I mean, let's talk about what we see in this chart here, and this is just a graph of the fourth quarter. What happened in the fourth quarter, Joe?
So, like I said, we saw sort of a rotation out of those large cap tech names and into some of the more asset classes that didn't participate in that huge price run. So you see here in the top line the Russell 2000 Value Index. Those are the value stocks for small companies in the U.S. They really lagged early in the year, and we can see here. Move this. We have 33.36% in 3 months. Nobody could really see that coming, but it's important to have that exposure already in your portfolio so that it does participate when you have these massive moves up in short periods of time. You can see on the third line the MSCI Emerging Markets Value Index. Emerging markets were largely sort of forgot about during that year. They didn't have the financial or fiscal firepower to launch $2 billion rescue packages, in those countries. But you can see here, almost 23% in 3 months. So, the S&P 500 index, which are the 500 largest companies in the United States, you can see it towards the bottom. By all means, we had a great year last year in U.S. stocks, but you can see here that there's a lot of other investable opportunities outside of large, U.S. companies that provided very significant returns, towards the end of the year. So, even real estate, which was badly hammered, early in the year, we can see did almost 16% in the fourth quarter. Referencing back to the MSCI All Country World Index, that's right in the middle. You're at about 17%. So again, also significantly outperforming the United States market.
Yeah, I think it's a great point, and it's also worth mentioning that value and emerging markets were laggards really up until this point. So it just sort of emphasizes the key around being diversified.
Absolutely.
So here we have sort of a longer term. That last slide was the fourth quarter of 2020. This gives us a longer term summary of some of the major asset classes. And what's the message here?
Well, really you can see that a rising tide lifts all boats in this chart. You can see that every major asset class except for global real estate had very significant returns last year. International developed markets, like I said, lagged early in the year, but with that big jump they took late in the year, ended up at 7.6% for the year. Emerging markets up 18%, also lagged very early in the year. Global real estate, that's a difficult one because that's one of the few areas in the market where people haven't really figured out what it's going to look like going forward. Obviously there's like us right now, a lot of people working from home that aren't using, their company's offices. A lot of retail is struggling with these lockdown orders, restaurants, hospitality, obviously travel has been highly affected. So, global real estate, I think, is going to be the last area that people really, figure out what it's going to look like in the year and years going forward. It wouldn't surprise me if that was the next asset class that had a significant snapback to the positive side. one thing we really haven't mentioned is bonds and the importance of bonds in a portfolio. I mentioned that's where we sort of pull money from, when we exercise our rebalancing disciplines. But last year was a bit of a strange year in that bonds had a very, very positive year. If you look here, 7.51% in the U.S. market versus sort of a longer term average of under 4%. Very rare that you see that kind of significant performance in both bonds and stocks in the same year. And it's really a testament, to sort of the value of having a diversified portfolio, because it was sort of an odd year in that if you look across our client base, those of our clients that have generally very aggressive portfolios with a lot of stock exposure actually had very similar year-end performance to our most conservative clients because of that bond exposure, because they didn't, those guys didn't participate in that downside volatility earlier in the year as much as the aggressive clients, but they also didn't participate, in the big boom as much because they have, higher bond allocations. But it ended up that pretty much everybody had a great year last year, regardless of the risk levels in your portfolio. So a bit of an outlier there. Like I said, 2020 was a strange year in many ways. But really, just serves to reinforce, the core disciplines and our core investment philosophy that, having a globally diversified asset allocation and having a disciplined sort of rebalancing approach, pays dividends over the long run.
Yeah, and I think this chart underscores just how unique last year was, right? We would expect bonds and stocks to have positive returns over a 10-year time frame, right? But on a 1-year time frame, they typically have seesaw effects. So it's rare to see stocks and bonds to have a positive year simultaneously.
Absolutely.
Okay, so now we have, again, we're going back to fourth quarter performance of developed markets versus emerging markets. And so talk to us, Joe.
Yep. Like I said, the U.S. is not the only place to invest. We can see here that, the U.S. is actually towards the bottom of this list of developed markets. You can see there, I think there's, it's just ahead of Denmark and Japan. But if you look towards the top and see some of these massive returns coming out of somewhat obscure areas like Austria, Spain, Norway, Australia, Israel, Italy, all over 20% in a single quarter. Again, just emphasizes that you shouldn't just look at the U.S. for investment opportunities. There are a lot of other countries out there with functioning stock markets that provide some great returns. You look at the emerging markets returns. Nobody ever thinks to look for investment opportunities in Colombia or Hungary, but they put up some massive numbers towards the end of the year. Really, there's only one country that had negative performance, and that was Egypt. But the important thing to remember here is that you don't have to go looking for individual stocks, in obscure markets like that to try to add to your portfolio. There are vehicles out there that give you broad exposure to all these areas. Those are the vehicles that we use. And essentially our portfolios participated in every one of these countries' performance because we have, small allocations across the board to really diversified, broad emerging markets and developed markets funds.
Yeah, I mean, who'd have thought Korea would return 36.42% in the fourth quarter? And I think Korea, as a nation, was the top performing geographic region. Am I right to think that?
Over the full year, I believe so.
Yep. Okay, large and in charge. It could be your nickname, Joe. A busy slide here. So why don't you walk us through what's going on? Obviously, we're looking at the 10 largest U.S. stocks at the start of each decade.
Yeah, so that's exactly right. What we're looking at, if you go back decade by decade, all the way back to 1930, this is a list of the 10 largest capitalization stocks in the U.S. market. So, all the way back in 1930, there's still some familiar names, AT&T, General Motors, General Electric, the venerable Exxon. And you can see that, if you follow those lines, those color-coded lines, some of those stayed in place for quite some time. AT&T, the largest stock in America from 1930 to 1960. Then it had a slight drop off where it was replaced by IBM, but it still remained in the top 10 for another 3 decades through 1990. Then it kind of disappeared off the list. You see General Motors, huge company for a long time, 1930 through 1960, it was the second largest company in the US, and it dropped to third by 1970, fourth by 1980, bang, off the list, replaced again. Exxon, which is a massive oil and gas producer, probably the most consistent on this list, starting in that fourth place in 1930, kind of staying in place through 1960, dropping a little in 1970, moving up and becoming the largest single company in the United States by 1990. Then you see it start to get replaced by some of these tech names. After the big boom in the 1990s, you have Microsoft coming onto the scene, Apple, obviously. If you look towards the right on this final list, you see companies like Amazon, Google, Facebook jumping up here. Walmart for the last couple of decades, obviously a huge presence in retail. Berkshire Hathaway, obviously Warren Buffett, he's a legend in our industry, and the stock price of Berkshire Hathaway reflects that. They've done very well, but the important thing to see is that you can, once something becomes a large company that sort of dominates the performance of the stock market, it's not necessarily going to stay there for the long term. Innovation happens, markets shift, economies, keep looking forward, and new inventions, come to the fray. So, buying these old familiar names is not necessarily a successful investment strategy. I have a kind of a fun quick quiz if everybody wants to throw a guess in on their bar down below. You might be familiar with the term FANG stocks. That's Facebook, Amazon, Apple, Netflix, Google. That little handful of stocks has really dominated the S&P 500's performance over the past several years. Despite there being 500 companies in that index, that little handful was responsible for a lot of the price movement of that entire index, because their market capitalizations are so huge. So, I'm going to have a little pop quiz here. What do you guys think? That those FANG stocks, what was their performance in 2020? Do we have any guesses?
Yep, we've got. I can see the chat feature. I can see some people are throwing out some guesses. 28%, someone says.
Okay. Any more?
We've got a 46, and let's see. We have a 50% and a 20%.
All right. Well, solid guesses. The answer was 61.5%.
Everyone under guessed.
Yep. So, I mean, it's remarkable. That those have had a nice sustained run here over the last several years. But the likelihood of that continuing over the next decade or 2 decades, if you have a long-term investment plan, not that great. And this next slide probably is a good illustration of that. Here what we're looking at is the top 10 stocks performance before they became, before they entered that list of the top 10 stocks, and then what happens to them afterwards. So we see here, in the time before they made it to that list, in the 10 years before, an annualized outperformance of 10%, 5 years, 19.3%. In the 3 years before they made it to that list, 24.3% over the excess return over the rest of the stock market. But what happens when you join that venerable list of the top 10 largest companies in the United States? We can see on the right side of this slide, for the next 3 years, a little bit of excess performance at 0.7%, roughly in line. Over the next 5 years, you actually start to underperform the stock market. Over the next 10 years, pretty consistent underperformance at 1.5% per year. So, the lesson here is that, growth opportunities tend to be in smaller companies. And once you become sort of a large company, you start to track the market. It's the outperformance of continued outperformance of those FANG stocks is really questionable, because how big can you really get? I mean, Apple is a massive company. Google is a massive company. There's antitrust issues that they're going to face. It's really tough to hang your hat on just a small piece of the market like that. You want to have exposure to the growthier areas, the places where that risk premium is rewarded, in the small company area, and can't just put together a portfolio with big, large cap, household names. The real investment opportunities are really outside of that.
Yeah, good point, Joe. So asset allocation, we're going to shift gears here a little bit. Asset allocation is a phrase that we throw around our company quite a bit. It talks to just how you pair the major asset classes to build your portfolio. There was a Nobel Prize won back in the early 1990s that proved 91% of your return is driven by how you commingle these asset classes. So it's not whether you buy Coke or Pepsi or Amazon or Google, or whether you buy the Vanguard fund or the Fidelity fund. It's just simply how you choose to allocate your money across these major asset classes. We do it because we know the asset classes sort of perform differently at various stages of the economic cycle. So this is a sample. This is just a sample allocation. It's roughly a 60-40 split between, we'll call it, stocks and fixed income. And we know over time roughly how this type of portfolio would perform. Of course, there are sub-asset classes within each of these pieces of the pie. Those are some of the things that we looked at in the previous slides. But we build an asset allocation designed for an individual's specific goals, their time horizon, their risk tolerance, when they're going to need the money, and that sort of thing. And then once we have that asset allocation built, we rebalance periodically back to the baseline. That is to say that if we target, let's say, a 60% stock exposure, and that stock exposure grows to maybe 65%, we shave off that excess 5 and add it back to the things that have gone down as a relative percent. And inherent in that concept is selling high and buying low. So a couple of the key steps in building a portfolio: choosing an asset allocation. The more stock you have, the more greater annual return over time, but the greater the short-term volatility. And the inverse applies to bonds. I know, Joe, that some of the conventional wisdom says, hey, in terms of rebalancing, we know that it's important and we should be doing it on January 1st and July 1st of every year. Why don't you talk about kind of what I would call the flaws with that, and then how we rebalance?
Yep. I think what happens when you have a scheduled rebalancing discipline is you leave some opportunity on the table. It really should be driven by what the portfolio is doing, and last year again was a perfect example of that. Pardon me, where we saw that huge drawdown in late February and into March, and then it shot right back up. Well, if you had a scheduled rebalancing, system, you wouldn't have done anything during that time. But when you let the market dictate when to rebalance, that allowed us to essentially buy in at very near the absolute lows of that dip. Get some great exposure at very cheap prices, and ride that recovery back up with that extra stock that we bought. And again, like I said earlier, it added significant performance percentages to our portfolios, that if we hadn't done that, if we just scheduled, hey, we rebalance at the end of every year, our portfolios probably would have underperformed by another 1 to 3%.
Right. In a fast-moving market, we may rebalance 3 or 4 times throughout the course of the year. And so I think it's an important component. And again, when doing that, it's inherent. We're selling high and buying low, and it's really, really important. Most individuals. There
are years that we might not even have to rebalance once. If prices are somewhat stable and both bonds and stocks, have similar performance.
Right. Okay, so this is a great example, this slide, of the real world implications of diversification. So we have the growth of $10,000 from 1998 through 2019. And that top line, that light blue line, I'll call it, is the stock market, the S&P. And then that bottom line, that darker blue line, is treasury bills. And $10,000 invested in the stock market would have grown over this period to $140,000. That same $10,000 over the same period invested in treasury bills would have grown to $20,000, right? And so at a glance, everyone wants the more money. Everyone would say, hey, I want to be invested in stocks, but then we have to be cognizant of the peaks and valleys along the way, right? And so what we want to do is be aware of an allocation and not have to sell investments during these valleys to fund needs, right? It's something called sequence of return risk. It speaks to the risk of having to draw down from your investments while they're at a loss. You have to sell more shares in that dynamic to generate the same dollar amount. And it's probably one of the worst things you can do with your portfolio. So again, this sort of speaks to pairing the asset classes to target a return that's right for you. And, think back to 2008. If you had to liquidate your shares to fund your needs, you were selling, again, more shares to generate the same dollar amount, and then you didn't participate in the recovery. So this is, again, just a great example of the real world impact of diversification.
Michael, could you go into a little more detail on how an investor should choose what that allocation should be, and how you sort of help clients, what that process looks like to arrive at what their asset allocation should look like?
Sure, we talked about it, but it's worth mentioning again. We can look at model portfolios and get a pretty good idea of the long-term performance of that model. It's sort of intuitive, but the more stock you have in your portfolio, the greater your annual return is going to be, right? That's kind of what this chart tells us, but the greater the short-term volatility. So we try to pair the asset classes to create the expected return and then tailor it to an individual's needs. Some people have a long time horizon. They've got decades of time to invest. And so we're going to weight those portfolios more towards stock, knowing that, hey, the short-term volatility is going to be a little greater than it would be otherwise, but the end result is that we'll have more money. For a short-term time horizon, we really don't have time to sort of weather the storm, to ride those ups and downs. And those portfolios would have a greater weighting towards cash and fixed income and things that are less volatile in nature. And so everyone's different. I mean, there's no one right portfolio for everybody, but we put a lot of thought into building personalized portfolios. It goes back to that pie chart in the previous slide, right? That's just one example. We can look at a model and get a pretty good idea what the long-term performance is going to be, and we tailor to each individual's sort of goals and needs. And there's also a behavioral finance element to it too, which is, hey, how do you feel about investing? What's your personal sort of tolerance for risk? I've met very aggressive investors, and they're in their 90s, and I've met very conservative investors in their 20s and 30s. So there is sort of a behavioral element to it as well, but it is somewhat empirical in nature at the same time. Mm-hmm. Okay. So what we have found is a lot of individual investors act on impulse. And I'm sure that no one in this webinar does this kind of stuff, but some individuals act on impulse. And what does that mean? That means, hey, when the market is high, they want to jump in. And when the market is low, they want to get out, right? It's kind of an emotional element to investments that we try to avoid. I mean, emotion and investments do not mix.
That's what leads to bubbles. We're certainly seeing that in the Bitcoin area right now.
Right. I mean, it's the inverse of what we do, right? The individuals say, hey, everything is going up right now. I want to get in, right? And that's like I said, the inverse of what we do. So in this slide is just sort of a graphical representation of that. People become optimistic, they become elated, and they want to buy. And exactly that time is when things start pulling back, and they become nervous and then fearful, and they want to sell. And it's a really bad cycle. It kind of goes one of my favorite quotes. It is by Warren Buffett, actually. Joe, you talked about him a moment ago, and he says, "Be greedy when others are fearful, and fearful when others are greedy." And so that talks to kind of just doing the opposite of maybe what your instincts are telling you to do. And sometimes I think that's very difficult.
And I would add, having a disciplined sort of approach before you have to actually, uh, endure some of these huge swings in the market, and that might sort of make you make some bad decisions because of the severity of those sort of emotions. If you have that plan ahead of time, it's much easier to make those decisions in a logical way. So, I mean, we have a very disciplined investment program where we know that if we see a 10, 15, 20, 25% pullback in the market, we know exactly what we're going to do beforehand. We know we're going to rebalance. We're going to harvest those losses. We're going to keep that asset allocation consistent, throughout those ups and downs. And that adds, significant performance, over time, but it also, sort of serves as peace of mind. It helps people sleep better. Knowing that they don't have to say, what are we going to do? What are we going to do? Michael, I know you fielded some of those calls from some panicked clients back in March. What did you tell them?
Yeah, it's I think I advanced the slide too quickly, but yeah, we'll go back to that. And thankfully, we trained most of our clients to be prepared for corrections. I mean, it's not a matter of if, it's a matter of when. But certainly, we had clients call back in March, mid-February, March, when things were really, really bad. And hey, I mean, it was sticking to the discipline, as you say, Joe. It's the basic blocking and tackling. You can't sell out now. You can't sell out when the market's down. In fact, you do just the opposite. You buy, you rebalance. And it's tough, it's tough. Every time it feels different, certainly in March of this year, when the pandemic hit, it felt really different, but it also felt different in 2008 with the subprime mortgage crisis. It felt different when the Twin Towers fell. It felt different when we went to war with Iraq. And I kind of liken it to maybe a martial artist who practices their movements each day, and then come game day, when it's time to react, you just follow your disciplines, you follow your training. So I know it's tough, and I know most individuals, or some individuals anyway, have that instinctual reaction to want to sell out, but you really can't do that, because when you do, in the one or two times I've seen that happen, then you've got to make the next decision when to get back in. And in 100% of all cases in the past, it's best just to stay invested. But it is tough. It is tough to remind ourselves of these things when the market's down 30%, in 3 weeks. But we've got to kind of rely on the discipline, as you say.
Absolutely. And one of the other sort of hot topics that we get from clients, following this very unusual election cycle that we've all just been through, is what are the implications for our portfolio with the new administration coming in? And I think this slide will help address that.
Right. So this is an interesting slide. We're given the average annual return for each of these presidents during their terms, right? And again, there's no rhyme or reason to it. What's interesting, I think, if we look at the far right of the slide, Barack Obama and Donald Trump, two guys who probably couldn't be more different in terms of ideologies. Look at the returns during their presidency. Really, really similar. Right? It's really, really hard to predict. I actually, Joe, I don't know if you know this, I actually did a little research. I dug a little deeper on this slide, and I looked at the growth of $100,000 from 1949 through 2020, and I charted that $100,000 over first Democratic presidencies, and that $100,000 would have grown to 2.9 million. And then I took that same 100,000 and I charted it over Republican presidencies, and that 100,000 would have grown to 717,000, right? But that same 100,000, if it was invested across all terms of all presidencies from 1949 to 2020, would have grown to 21.1 million. Right? And so I think that speaks to how you can't really predict what's going to happen with presidential elections. Oftentimes what you think will happen doesn't. And that's been my experience. Anytime something's a sure thing in the capital markets, it usually doesn't happen. It just speaks to the concept of not trying to outguess things. We don't know what the president is going to do in terms of an effect on the stock market. It's just best to kind of hold the course and maintain that discipline.
Mm-hmm. Well said.
And so, kind of similar. What do you see here, Joe? This chart doesn't focus on presidencies. This chart focuses on Congress. And what does this chart tell us?
Well, if it tells me that stock markets move up and to the right over longer periods of time.
I like that.
There are certain political issues and things that come up that people think will imply some sort of significant movement in the market, either positive or negative, because they don't like the the political repercussions of some of these actions. But what we see is that as time periods increase, realized returns fall in line with expectations. So you can have these short-term ups and downs in the market. Last year was a great example of that, where you had a 33% drawdown in a matter of weeks, followed by a massive recovery. Over time, the stock market's still probably going to average around 10% a year, regardless of whether the Republicans or the Democrats are controlling the Senate or the House or the executive branch. You can see that stock markets over time, the longer you stretch it out, the less volatile it looks. And so if you go into this with a mindset of I'm going to be invested for the next 20, 30, 40 years, that volatility looks less important in the short run.
Yep, and I think what the past two slides showed us is that you really can't guess what the market's going to do based on the ideology of the administration, right? I like what you said, Joe. I see two colors and I see the market going up, right? That's the simple terms. So we don't know what's going to happen moving forward, because we got a lot of questions around that towards the end of the year when it became sort of evident that we would have a new president. So.
What question I never get? We talk about the political stuff all the time, but nobody really ever asked me about the Fed. And I would argue that the Fed has a much larger impact on asset class returns, than anything political related. I mean, you look over the past decade, there's probably been a roughly 90% correlation between the S&P 500's performance and the size of the Fed balance sheet. They've injected massive stimulus into this economy, and it's reflected in asset prices across the board, from real estate to stocks and bonds, to more obscure asset classes. They're pumping money into this economy and prices are going up. And I don't see a change to that anytime soon. Obviously last year, with the volatility, we had to lean on fiscal stimulus rather than monetary stimulus, because they've sort of spent a lot of their ammo over the years, bringing interest rates down to near zero, making these massive bond purchases on their balance sheet. So I think fiscal stimulus is going to be really the name of the game moving forward. If we do see any more rough spots due to the pandemic and or any other items that might sneak onto our desks in 2021.
Yeah, well said. And I like short, simple statements. And with respect to this chart, what I will say is red and blue make green.
I like that.
Okay, so important reminders for investors, right? And now we're going back to 2020 and kind of what happened in the capital markets. It's always different. I talked about that a moment ago. I mean, it felt different this year. It always feels different when we have a correction, right? But you have to have a belief in the resiliency of the capital markets, and we certainly do. And then uncertainty and returns are related, meaning the greater risk you take, the more you would expect to be rewarded, but over a longer period of time. Joe, talk to us about expected returns and realized returns and how they can be different.
I think it goes back to sort of, the importance of asset allocation. When we lead every client engagement by putting together a financial plan before we ever place a trade. And that plan helps us sort of do the reverse math and figure out what the expected return we need over any given period of time is for those clients to reach their goals. And that determines what their asset allocation looks like. So when we run these plans, our software will calculate sort of what the historical return of a given portfolio is, and it'll project that out into the future. And it'll use, a linear return assumption of, call it 8% for a 60-40 portfolio. And so we assume when we look at those plans that, the stock market's going to do 8% every year for the next 30 years or however long your retirement looks like. But that's not real life. You can have that 60-40 portfolio average 8% over time, but in any given year, it's rarely going to be 8%. It's going to go up 16, down 4, up 5, up 12. But over time, like I said, as the time periods increase, realized returns fall in line with expectations. So last year, returns were all over the board. But we know that over time, if you stick to your plan and keep your asset allocation consistent with your risk tolerance and with the plan, you're probably going to realize those returns over time.
Yep, no, that's great. I mean, I think it's worth noting that you kind of alluded to a deterministic model where we do use linear returns, but we also take into consideration probabilistic modeling through Monte Carlo simulators. So we're not always relying on linear returns. We use more random chance returns as well, because we don't want to pitch our flag in any one camp and rely on linear returns. So many investors
is to not overreact in the short term.
Right, exactly. And so the next point, many investing questions were around market timing. We touched on that. When should I get in? When should I sell? And really, there's no magic bullet. There's no unicorn in investing, right? I mean, the best thing is to pick an allocation and just weather the storm. And I try to show you guys that with that sort of the analogy with the presidential terms. And so what we really want is logic, evidence, diversification, and a long-term approach, right? That's another way of stay invested, stay diversified, and then rebalance periodically. That's it. Those are the really 3 important steps.
Yeah. So the rebalancing discipline itself forces you to buy in at the right time when markets are cheap.
Right, and it's overlooked.
Money over time.
Right, it's overlooked. I mean, I think it's one of the most important steps. It's an easy step, and it's very overlooked. What we typically see is individuals coming to us with a hodgepodge of investments that they've accumulated over the course of their lifetime with no rebalancing strategy whatsoever. So what our takeaway here for you guys is we want you to focus on what you can control, right? You can't control the stock market. We tried to show you that we have no idea what's going to happen in the short term. So we need a disciplined approach, and that's just a way of behaving that allows us to follow rules, right? Especially through big swings. And we had a big swing this year. We're certainly going to have big swings in the years ahead. And so we want you to have a plan. That's talks to having an asset allocation, the right mix of stocks and bonds and sub-asset classes for who you are as an investor, your goals, your risk profile, and so sort of some of the behavioral stuff we talked about as well. We talked about risk management in the context of rebalancing. And so again, it's a really, really important strategy. What we didn't get into here are fees, right? Most individuals don't know what they're paying for their portfolio. So we want you to be cognizant of expense ratios, turnover and taxes, right? And so the last point is taxes. Right? Taxes for most Americans is going to be the biggest expense you pay over the course of your lifetime. So that is one of the things you can control. We talked about it during this presentation in the context of tax loss harvesting, but there's a lot of other things you can do to sort of control taxes. In fact, we have a webinar coming up in exactly 2 weeks from today. We're going to look at Biden's tax proposals. Nothing has passed through Congress yet. There's nothing really written in stone, but there are some really significant tax law changes in the works on individual taxes, corporate taxes, retirement plan taxation, capital gains, and things like that. We're going to do a whole webinar on that in exactly 2 weeks. So we're going to invite you to join us for that. And I think, Joe, if you have nothing else to add, we're just going to open up for questions. We have a few minutes left.
Sounds great.
Okay, so just as a reminder, you guys can use that chat feature in your toolbar to submit a question. And I see someone's asking a question already. Okay, let's see. Oh boy, Joe, I'm going to let you handle this one. What is the S&P going to do in 2021? I'm going to let you go with that one. So someone wants to know what the S&P is going to do in 2021.
Let me consult my crystal ball. One moment.
That's a great question.
If you've been paying attention for the last hour, we don't know. We don't make predictions like that. It's obviously, there's a lot of factors that can come into play. We don't know what the rest of this, pandemic looks like, the vaccine rollout, Biden's tax plan, the possibility of another round of stimulus. There's any number of things that can happen that'll drive the performance of the S&P. Your guess is as good as mine. I just know that we have a plan on how to react, whether it's up, down, or somewhere in the middle.
Exactly right. I'll put it in simplistic terms. If we knew what the S&P was going to do over the course of 2021, we wouldn't be working, right? I'd be on the couch right now, right? Okay, we have another question coming in. Do we anticipate another round of stimulus? And would it be good for the economy? Would it be good for the economy and nation? So do we think there's going to be more stimulus, Joe? And if so, is it going to be a good or bad thing on a macro level?
So obviously, we're in a very contentious political environment. There's been a big push for what's been labeled as a $1.9 trillion round of stimulus. There seems to be some pushback right now coming from the other side, looking to make more targeted, payments to individuals or small businesses, et cetera. I don't know what that's going to look like. It was just announced this morning that the Democrats might even consider using a process called reconciliation to get past any sort of Republican pushback on this stimulus bill. Your guess is as good as mine in this type of environment. I do think we will see something, because I think everybody recognizes the need, that a lot of people are going through a lot of, some very challenging times. If you look at, the amount of renters that are at risk of losing their homes and how far they are behind on back rent, that number's in the billions and billions of dollars. Small business owners are struggling. There's a lot of people still unemployed. So I think we'll see something, and I think it'll probably be large. Will we see that same jump in the stock market in reaction to a stimulus bill passing that we saw in late March of last year? I think in a large part, a lot of that's already priced into the market once Biden took the White House. So again, we'll see. My worry is more towards longer term structural issues, relating to the size of the U.S. deficit and the debt loads. We've been spending in numbers that we haven't seen inflation adjusted since World War II. So there are longer term implications of that. And, I think to some extent, even Biden's tax plan gets sort of woven into this spending, because, obviously you've got to balance the books somehow. And I think all this stuff is related, and it's going to be a very interesting year to see, what happens.
Yeah, good point. I mean, I liken the stimulus to like a sugar high, right? It's like eating a candy bar when you're hungry. You get an initial sort of blast of energy, but then there's longer term ramifications, and sometimes that energy sort of wears off, right? So we don't know whether another round of stimulus is coming, or whether it will be good for the economy. There probably would be like an immediate sort of burst. That's what we saw back in March, right? That the trough on the chart corresponds to that $2 or $3 trillion stimulus package, the CARES Act, right? So let's take maybe one more question. We're kind of getting towards the end here. Let's take one more question, and then everyone on the webinar will be receiving a survey via email. Please rate us. We have tough skin, but also in that survey you have the ability to submit a question. So if there's a lot of questions lining up, feel free to submit that question in writing, and we'll try to circle back with you and address it. But the last question: I understand your issue about entry point into the market, but if the general view is that the second half of this year will be better than the first, should we wait to enter, possibly take and not take an initial 5 to 10% hit, which might take a year to make up? So again, market timing, Joe. How do we feel about market timing?
Well, I would tell you that if you look out 5 or 10 years from today, your average annualized returns are going to be very similar whether you enter the market today or wait 6 months. Those short-term fluctuations end up not really mattering so much when you look out over longer and longer periods of time. Like I said earlier, as time periods increases, your returns become more predictable. So, whether you get in 5% lower today than you would 6 months from now, what matters is time in the market, not timing the market. You just want to make sure, like I said, stocks tend to move up and to the right. And whether you get those, whether you enter here or here in those tiny little fluctuations over longer periods of time, really doesn't matter.
No, that's exactly right. I mean, you're
just as likely to experience opportunity costs, if you try to wait, as you are, getting in at a cheaper level.
Right. No, you can turn on one of the financial shows on the news, and you'll see or hear one talking head talk about how we're going to be in a bull market for the next 3 years, and then a half hour later, you're going to hear another talking head talk about how we're headed for a recession. The reality is nobody knows. Nobody knows, and so we don't promote timing the market. If you want to invest, there's no better time than today, because we know long term that the market goes up, and it's probably as simple as that.
What we do know, going back to your comment on fees, is that when you pay people to make those decisions for you, they're active managers that are picking individual stocks and timing the market in and out. We know you're paying more, and that comes out of your returns. Whereas if you take more of a passive, intelligent approach, and you save on fees using some great vehicles that are available to people, that money that you save ends up on your bottom line. So that's the easiest way to make money.
Perfect. Good. Well said. Okay, so I'm going to go ahead. We're right at the sort of the one minute to noon mark. I'm going to go ahead and shut it down. Be on the lookout for that survey that you should be getting through the email that you registered through. Thank you very much for joining us. We hope you got some good information.
Thank you.